Hello, this is Brian Shannon from AlphaTrends.net. It is Wednesday, July 23rd, 2008. The markets just closed, and we had another impressive session. The S&P 500 spiders finished with a gain of 87 cents, or 2/3%. We remain above the January and March lows in here, so that's impressive, and we'll now look for this level on any pullbacks to become an area of support near about 126. If you remember yesterday, also just below that, there should be some support found near 125, as that's where this last little move began from after a slight pullback. It found support near that rising 5-day moving average, and then yesterday afternoon we saw a real push higher, and that continued to materialize this morning, and then we held on to the gains late in the day. So again, the 5-day moving average remains higher, so we want to give the benefit of the doubt in the intermediate term to the buyers, but you have to remember that this is a recovery within a downtrend. And right now, if we take a look at Fibonacci on here, yesterday I pointed out from the mid-May high to the recent lows, we're now right at about that 1/3 retracement, or 38.2% Fibonacci level, and that's a lot of times where we see the market consolidate a little bit. So again, just nothing here on this time frame here, the 10-minute time frame, suggests that there's any selling that it looks like we need to be worried about, but you always have to be vigilant, because again, the larger trend is still lower here on the daily and the weekly time frames. But it still looks like from a just from a as far stretched as we got on the downside, it looks like it could still continue to bounce higher. So you don't want to sell short until the evidence is there that says it's time to sell short. And right now, we don't see that evidence yet. So short term, the buyers remain in control, and how high it can go is anyone's guess. If we consolidate a little bit here, then I think and then the buyers come back again, then that 50% retracement level looks like the next upward target, and that's approximately where we'll encounter the declining 50-day moving average as well. So oil obviously continues to be a factor in this, and the oil market just continues to decline, which is obviously a good thing for our economy and the psychology of investing in equities. The trend line broke last week, and it doesn't always mean that a reversal is at hand, but that's what we have here, is that oil has reversed lower. This prior level of support, it did find resistance at on Monday, and we take a look at the hourly time frame to get a better look at that. Here's where we see this prior support acting as resistance in here, and also again we've got a declining 5-day moving average. So as long as that 5-day moving average declines, the intermediate term is guilty till proven innocent. Yesterday I said that if you were short, that you probably wanted to use this level, 106.80, as a stop area, or as the trend line, which is approximately where we find that 5-day moving average as well. I think at this point you could probably lower your stop either to right about 104.60 or so, or even just this lower high right here. You want to use the definition of trend: lower highs and lower lows. So you look at what would interrupt this downtrend is if it were to make a higher high, and that would be pushing at this point back up above about 104 or so. And here's the 10-minute time frame to get a little bit more detail on that. So if you're short in there, you've got a good trade going. Obviously, the DTO is the one that I said that this is what you would probably want to use this vehicle to gain the short side exposure. So similarly, if you were long this, then you would probably want to put your stop somewhere right around here, because at that point, if it was to break down, it would make a lower low and then therefore invalidate the definition of uptrend here. Let's see, so gold, a couple days ago, these things can change very quickly. A couple days ago, it looked like maybe it was going to hold along this trend line here on the daily time frame. It looked like it was breaking past some resistance, pulling back on light volume to the rising 10-day moving average, but we saw that it broke down through that 93.90 level, and I said if you were going to be involved, you want to put your stop below there. And basically yesterday I said stay away from this one, and I think you do want to stay away from gold, because it looks badly damaged right now, and there's really no reason to try and pick a bottom. People have been trying to play that game in UNG. This is the natural gas ETF, and no sign of a bottom in there yet. This would be a good place to maybe begin to look for evidence of buyers regaining control, because we have large volume in here, and we have the 200-day moving average, which often acts as support. But when you look at the short-term trend, it's still definitely lower in here, and there's nothing here to suggest that the buyers are stepping in. The UNG finished right at the lows for the day, so maybe you keep your eye on it and stalk it over the next few days, but don't be a buyer in there yet, because obviously the odds just don't favor it at this point. The Russell 2000, again, this is the real leader of this recovery. It's the group that failed to break down, and it's the group that's bouncing hardest. It's right up to the declining 50-day moving average, actually just above the declining 50-day moving average, and also up to this level where we had seen that prior support give way at about $72 a share. So we are at an important level here. We're close to the declining 200-day moving average. I think a little consolidation in here would be a reasonable thing to expect. This market, though, has been just stair-stepping nicely higher in here, higher highs and higher lows. Breaking below this level here, 71, would maybe give us a little reason for concern, is this might be the beginning of a short-term, at least, reversal. There's no sign, though, really, when you look in here. We've got the rising 5-day moving average. The only thing that I'm looking at here is the potential that this is a lower high, and if it breaks below that 71.10 or so, then maybe we get a little bit further pullback. But I don't expect it would be very deep, maybe down towards this prior level of resistance near just below $70 a share. But the IWM continues to be the healthiest group here, and really is giving us a lot more reason to be hopeful towards a lot of these markets, including the Nasdaq 100, which did get above that 45.23 level that we had been discussing. And let's take a look at the 30-minute time frame for that. 45.23 was this level here. What we saw was early a real strong move higher that was basically a continuation of yesterday's move right here. Market closed right around that 5-day moving average yesterday. It continued to run very strongly higher here early this morning, pulled back to the 5-day moving average, and then finished with a little strength. So if we take a look and back it up here on the 30-minute time frame, we still see that $46 level is clearly important, but we're back above this level, so it does look to me like we can now say that this looks like our inverted head and shoulders pattern, and this obviously being the bottom of the right shoulder at $44 a share. Any break below there is going to be deeply damaging to the market. There's nothing to suggest that would be coming at this point. The 10-minute time frame is clearly looking a lot better. And back to the 30-minute time frame again, though, if we take a look very conservatively and say from 43.5 up towards $46 a share, and we add that to the breakout point, 43.5, so that'd be 2.5 points. That would give us a potential upside target near about $48 a share. $48 a share is also the level where this market really began, first made this lower low right here, and also approximately where of the declining 50 and 200-day moving averages. So all in all, these markets are recovering. I think that more important really than 44 right now, as far as support, I would say that your better level where you can keep your risk a little bit tighter would be below this low right here. So switching again to the 10-minute time frame, the pullback at this point came down to about 44.75 and then started moving higher. That also coincided with the 5-day moving average. So this level takes on a little bit of meaning at 44.75. Breaking back below there, I think you want to get a little defensive once again. But the market's showing some real improvement here, and it's got a lot of good things going for it with the breakdown in the gold and oil and the strength in the dollar and that sort of thing. Financials, obviously, they're recovering, maybe slowing down near this 50-day moving average. This is also an important level. This is the Bear Stearns low right here. So this is going to be important as far as the financials go, and there's no sign yet of a reason to sell short in here, but similar to what I was pointing out in the IWM, this could be a lower high and breaking below here, maybe a lower low. We do have a rising 5-day moving average, which makes it still too early to really get aggressively short. But this SKF just makes some massive moves intraday, and if you're a nimble trader, then this might be a good thing for you to consider. I mean, here we've had a 100-point range here in the last week and a half.